Okay, so good morning, everyone. Welcome to the Macro Snapshot. It's a new week, Monday, 17th of February, 2025. Recording this about 7:30 in the morning. Keep in mind that today is the cash market is closed. It's President's Day, so the cash market for equities is closed in the US. We have the futures closing around about midday, so it's going to be pretty low volatility. And probably low volume. Let's see what happens. So it's a good time just to do a bit of an overview and see where the markets are. So let's just have a quick look at that. And what I want to do is to sort of start off with just a couple of ratios which I like to look at, just to sort of get a sense of, are we in a sort of a risk on or a risk off kind of situation? So what we have up here, I keep a bunch of sort of stocks versus other instruments. So if we look at, let's say, something like SPY over IEF, which is the shorter term bonds, we can see that the stocks here is still, solidly almost pushing upwards against the stocks. If we look at SPY versus TLT, of course, the 30-year bond ETF, we can see that that's certainly not falling and collapsing, and that's holding up at highs. And you can see that maybe it's not, it doesn't have this explosive growth to the upside, but it's certainly sort of holding in there, and it's not signaling any immediate kind of risk off kind of appetite. If we look at a couple of others, we can look at QQQs over the TLT, and again you see that that had been in a bit of a range and is now sort of pushing up. If we look at, let's say, the totality of the stocks, which is ITOT over government, you also see that looks almost as though it's pushing up. So no matter what our views, and what could we think about? We could think about that. Maybe there's going to be sort of a lot of government workers fired. We're hearing about firings all the time. Some of the numbers we've heard is like 250,000 US government workers, maybe being made redundant, unemployed, especially in the Washington, Virginia sort of area. Is that going to lead? They're all getting nice payouts, but is that going to lead to sort of a slowdown in consumption? We saw retail sales was a little bit soft last Friday. Is that pointing to a slowdown of the US consumer? We're getting cuts apparently from the Doge, Musk and the Department of Government Efficiency. They're trying to cut budgets here, there, and everywhere. So the point is there is some sort of sense that, maybe the US deficit will be lowered, that there's going to be less spending, there's going to be some unemployment happening, rising unemployment. Is this sort of cut to sort of the budget deficit and budgets in general, will that lead to less liquidity? But the point is, until and unless we get, technical indicators, and that's what I'm trying to say here, we're not really getting any technical indicators which are saying that the stocks are due to collapse or even to fall, which is not to say they can't have a 1 or 2 or 3% correction. But in terms of some kind of recessionary data, we're not even getting that either. Remember, we have retail sales, which, yes, were a little bit soft on Friday, but the previous month's revisions were actually upwards. So I think we can say that, and all, things are sort of not bad with the US consumer. Okay, so let's just keep on going on. The other issue, which is interesting, the ITOT government one here, if we look at, let's say, this level down here, about 560 odd, that's kind of where we got the Trump election. So keep in mind here, on the evening of Trump's election, about the 5th or the 6th of November here, we had this gap upwards. So the thing is that at this point, this is looking quite solid, but this would be an interesting level to watch in terms of sentiment. So I'm going to look at this sort of, let's call it the Trump election gap kind of level, which is around about 5.6, 5.61 on this particular ratio here. And I would say that if we get that the stock's underperforming bonds, which is what this is trying to tell us, and it pushes down here, that could be some kind of sign of a risk on kind of situation. The other issue as well, it could be a question of a few weeks. We know that Trump late last week talked about putting on reciprocal tariffs. Any country which is, has tariffs on US imports coming into their country, they're going to slap the reciprocal kind of tariffs on, well, a similar kind of tariff reciprocally. But again, that's not going to happen apparently until April the 2nd. He said April the 1st is April Fool's Day, so I preferred April the 2nd. So that's still, where are we? That's still like 5 or 6 weeks away. So there's plenty of time to negotiate. There's plenty of time for compromises. And I think at the moment, what's happening is that the market is sort of like 20% nervous, saying, Trump's unstable or unpredictable. We could be getting tariffs. But the other 60 or 70% of the risk on is saying, well, he's just trying to sort of extract from various markets and various countries and various governments very specific concessions, symbolic concessions sometimes. And so, hey, the market and the economy can sort of do what it needs to do because Trump will not sort of go to the nuclear option of, a universal tariff of 25 or 30 or 40 or 50% on countries like China or, Vietnam or Brazil or even Europe. Although he did say at the end of last week that, he's still quite keen, potentially, of putting sort of tariffs on imported cars from Europe, which would be pretty bad for Europe. So all that to say that if we look at these sort of ratios here, things are not too bad. If we look at something like SPY over emerging markets, which we've got here, that one actually is down a little bit. So the point here is that SPY over emerging markets, that would indicate that the emerging markets, at least in the last couple of weeks, has outperformed the broad US sort of stock market, which is a positive for risk on. That's basically saying there is some kind of a risk on in the markets. Okay, so let's just go back to our regular stuff here. Let's have a look at sort of bonds here. Now, bonds last week, if we just go to I'll bring up a few of the yield charts here. But if we just look at what happened with bonds last week, not a huge amount happened. Here's the 2-year yield, which sort of went up and then went down. But so actually on the week, if we look, essentially closed unchanged, and that sort of makes sense because we had a CPI which was a little hotter than expected, but then we had the PPI which was a little soft, and the key elements of PPI which feed into the core PCE, which of course the Fed looks at, they were actually a little bit on the soft side. So a lot of people who are in the business of crunching numbers, basically fairly quickly after we got the PPI data, sort of said, well, hey, this actually is a positive, or let me not say positive. This is actually good news in the sense that the core PCE, if anything, that could go down a little bit on these numbers. So the bond market quite liked that. But having said that, I think something like the 2-year yield here, we're probably going to be range bound for at least another 2 Fed meetings. The Fed at this point will need a lot more information on inflation going up or down to cut or to hike. On the other hand, in terms of the general economy and growth, they will also need to have a lot more information, another 2 or 3 months information to know whether the labor market is really deteriorating, whether growth is really falling off to maybe potentially cut. So I think realistically here, something maybe around about 4.33, where are we? Something around about these levels up here, probably going to be the top of the range for the 2-year yield just for the next few weeks or so. And I think, to be honest, there's no real reason for it to go below about, let's say, 410, 411, 412 on the 2-year, because the Fed, in order for that to happen, the Fed would have to cut. And in order for that to happen, it would have to have an exogenous, kind of shock, some kind of geopolitical shock, like a war breaking out, or we would have to have, I would say, at the very minimum, like 2 shocking employment reports, like sub-zero employment reports and, or growth indicators going down. And I don't think we're going to get that. So I think at this point, probably the 2 years going to just be range trading, as I said, from about 4.4 down to maybe about 4.1, basically about a 25 basis points kind of range here. And essentially what that means, I think, is that the action is going to be at the back end of the curve, in the sense that I think the front end is going to be the anchor, and that's probably just going to sort of bobble up and down 10 or 15 basis points, waiting for more sort of structural information about growth and employment and inflation. Whereas I think the back end is the one which is really got to sort of react in a more volatile and sensitive fashion to any data about tariffs or growth or employment or inflation. So we're going to see that curve going up or down on the back end. Excuse me, just having some, what am I having this morning? Earl Grey. Okay, similar kind of thing if we look at, let's say, the 5-year, again, I think is probably, something like about 4.27, down around about here is probably going to be the low for that. If we look at the 10-year, which of course is the benchmark, I think, something like around about 4.35, 4.3. So you're looking around about here, there's 4.39, but I think, that's probably going to be the limit there. And the maximum probably up to about 4.6, 4.58. So something up around here. So again, just basically in these sort of trade ranges. And that makes sense. And that's reflected if we look at the MOVE index, which is, sort of a general index, sort of an average of volatility on the bonds. You can see here at pretty low levels, around about 84 or so. And that's been relatively supportive for the stocks because, as we know, I've looked at a lot of charts that stocks are anti-correlated to high levels of the move. So as we see the move index of bond volatility moving up, that is generally a negative for stocks. But as you guys can see here, we're at pretty interesting levels here. In fact, if that can break through this level of about 83-ish, and that goes down further, that could give quite a bit of a a tailwind rather for the stocks with a very low sort of bond volatility. And then if we look at a couple of the spreads, so let's look at, let's say, like the 210. If I can find that, yeah, that's a 510. So let's look at the 210. You see that this has been flattening here, bull flattening. So the idea here is that the front end of the curve is just waiting on the Fed, and is kind of pretty much anchored. And we've seen that we had a little softer retail sales. We saw that the PPI and maybe the core PC is not too bad. And we're seeing that, some evidence that maybe expenditures will be cut at the government level. So all of that has been supportive of the long end of the bonds, which of course pushes down the yield, putting up the price and pushing down the yield. So we have seen some sort of long end led bull sort of flattening, but we're at quite an interesting level here. And the thing is, can this go down, another few basis points? Yeah, it could probably go down to maybe like 10 or 11 positive, like, plus 10 or 11 sort of basis points. But I think, if we look at that, that's probably going to be the low. And if we look at something like the EMAs here, maybe something like this 100-day EMA, would maybe be a limit, something around about that, or maybe even like the 200. It could go down a little bit more. I don't know. But basically, that's going to sort of, I can't see that going down too much more. Where it's interesting is actually looking over in Europe, because the situation in Europe, we know that there's been a lot of geopolitics, which we'll talk about at the moment. And we've seen, we know that the ECB at this point, they're on schedule to cut a bit more. And let's have a quick look and just see what's actually priced in at the moment. Let's have a look. I think we've got that here. So if we just have a look and see what's actually priced in at the moment for the ECB, definitely much more dovish than the Fed, whichever way you cut it. So if we look here, let's say what's priced in by the last meeting of 2025, we can see that 3 cuts are priced in. So basically about 75 basis points. You can see here 76.9. So basically 3 cuts are priced in for the ECB. But the question is, can that go even a little bit lower? And what we're seeing here, we've got the German election coming up in a week, in 1 week's time, which I won't get into, but that's going to be quite interesting. We've got this whole idea here that, there could be a peace dividend because of the Ukraine, a cessation of hostilities in the Ukraine. But the reality is that the European economy remains relatively soft, and that, that they may need to be cutting more, certainly more than the Fed. But the thing is, here's, if we're looking at 2.24, let's have a look on the top end, probably 2.24 up around about here, or 2.3, 2.33. So this zone up here, that's probably a pretty good time to be buying the Schatz, so the front end of the curve. So that's the 2-year in Germany. So anytime you start seeing the yields up, as I say, about 2.27, 2.3, that could be a moment, which also is getting up towards that 200-day moving average up here. That could be a good time to be going long, just because A, the ECB is probably going to be cutting 3 times. B, the economy is relatively weak. And C, it's got to be certainly more dovish than the Fed at this point. So I can't really see any scenario at the moment on the horizon whereby the front end of the German curve, pushes higher to 245 or 250. I just can't see that at the moment. On the downside, you've got to say that. Let's have a look on the 5. Sorry, I just want to look at the 5 here. Similar kind of situation on the 5, maybe up here, 2.35, 2.4, something like that. That's probably going to be the limit for the bobble as well. But I think, the Schatz at the front end is probably the one. So what are the risks to all that? The risks here is that in Europe, everyone's sort of getting quite happy, the last few days. It's like, oh, there's going to be a peace resolution in Ukraine, and suddenly Zelensky is going to give up land, and Trump's going to divide up the world with Putin, which could happen. And there's going to be a peace dividend, there's going to be reconstruction, and European companies will benefit from that. And, the tariffs are not really going to happen. But personally, I think there's a reasonable chance, and I'm just talking as a trader from a probabilistic point of view, that Zelensky, we saw this morning, is already saying, hey, any deal which doesn't involve us is a non-starter. And secondly, he said he's not going to be giving up land. And we also had Lavrov, who's the wily old fox, the foreign minister of Russia, saying this morning, reading, that the peace meetings next week between the Russian officials and U.S. officials in Saudi Arabia do not involve the offering of giving land back to Ukraine, of giving up land won in the war. So we have the Russians in the form of the Foreign Minister Lavrov saying, "Hey guys, our opening position is not to offer any kind of land concessions to Ukraine." Zelensky, president of Ukraine, is saying the same thing. So the point I'm trying to make here is that there are still risks, in my opinion, that this maybe is like sort of a happy moment the last 2, 3, 4 days. But I think there's still substantial risks that in some shape or form, we will still get tariffs imposed, on various countries, but also the European Union. And secondly, that the peace talks in Ukraine are going to be, let's just say, more difficult, messier, more complicated than maybe the market is pricing in. The market at the moment seems to be pricing in that suddenly, there'll be, sort of a cup of tea in a half-hour meeting, and all the nasty people will go, "Oh, wait, but excuse me." But I don't think that's at all the case, and I think it's going to get nasty, and there could be some market ramifications for that. What's also kind of interesting, just while we're over in the European space here, is to look at some of the spreads here, and I've got. I want to see if I've got the German. So I'm just trying to find, I seem to have a lot of things here. Where am I? Yeah, so let's just have a look here. For example, this is the 2-year US minus or subtract the German 2-year. And what you can see here is that that's come in a little bit. So basically the US yields are getting closer to their German counterparts. But I think, that could go in a little bit more just at the moment as the front end is kind of stuck or stable in the US. I think that could just drift down to maybe 1 point, down here somewhere, 1.92, 1.93. That would be quite an interesting sort of trigger point, because if that comes in at that point, for sure, that would be an interesting level maybe to be buying the shots, buying the front end, because that's sort of indicating that would be like a maximum sort of point here. So that's kind of an interesting one there, also in terms of the euro. So let's just look at a couple of other markets here. Let's start off with the euro. Again, just talking about this sort of peace dividend, which are people saying it's going to be deflationary, lower energy costs for sure, maybe lower nat gas costs. The ECB can cut even more because it has less deflation. That's a possibility. If we hypothetically do get a quick resolution to the situation in Ukraine, could it be that suddenly there's more nat gas flowing from Russia, so energy costs come down? That would be at the margin deflationary. Therefore, the ECB could cut even a little bit more. And again, that's another reason why potentially one would want to be buying the shots, which is the 2-year German. But let's have a look now and look at the euro. And we see the euro has rallied quite a lot against the US dollar at this point. Now, can this go up a little bit more? I would say, maybe 105 and a half up to 106. But the thing is here is that before we write off the US dollar, still the world's strongest economy. It's still an economy which is the world's reserve currency. That still has some sticky inflation, still has a central bank which is no hurry to cut. So I would say, and it's interesting this morning, starting to get just a little bit of a red candle here. I would say that anywhere up towards here, around about 106, could actually be quite an interesting entry point to be selling the euro at that point. But again, it could take a week or two to get up there because we just need to see what's going on in Russia and whatnot. If we look also at the dollar index, a similar kind of situation, it could come down a little bit more. But again, you see that it's come back down into the trading range, which is this pink box. As we talked this morning, it's hitting the 100-day exponential moving average. And again, I think that's probably going to find a basing situation, around about here. What is interesting is that the US dollar and the Japanese yen, we see that the yen just continues to show more and more strength. So this is USD JPY. So this is showing Japanese strength as this is going down. The US dollar is going down. We had overnight strong GDP numbers, very strong GDP numbers in Japan. So that's signaling that the Japanese domestic economy seems to be doing quite well, which of course will give the BOJ more encouragement to continue the hiking cycle, 1 or possibly even 2 more hikes this year, in stark contrast to a lot of the other developed markets, central banks. So it looks at this point that the next stop is at least to retest down here, 151. If it breaks down there, you've got to say this could be going further down. So that's definitely quite an interesting one. Something also which I've been looking at is things like some of the risk currencies. So you see the Aussie dollar breaking out pretty nicely against the US dollar. Again, this is all based on this idea that, less tariffs being imposed universally, specifically on China. There's been this bit of a recovery in the Chinese stock market, specifically like this, some of the tech stocks. With DeepSeek and everything. And also this idea that maybe it's going to be a little less geopolitical risk and et cetera, and the other macro factors. So things like the Aussie has been doing quite well. We have the Reserve Bank of Australia, which is supposed to cut. We have that decision basically coming up tonight. So let's just look at that. That's priced in for 25 basis points. So if we just see actually what is priced in here, we see that at the meeting, which is on the 18th. So that's going to be tonight, our time, North American time, at about midnight or so. We've got 22 basis points priced in. So almost the full 25 basis points priced in. And what the market is possibly expecting is a hawkish cut. Again, remember that the Reserve Bank of Australia has not cut for, gosh, I can't remember, but it's like at least a year or two. It's like it's been on hold for a long time, and it hasn't cut yet. It has not cut yet. So this will be the first cut in potentially a cutting cycle. So I think the Reserve Bank is going to be relatively conservative. So it's going to be relatively hawkish through communication. They will signal the fact that the domestic economy is still quite strong, that they're in no hurry to cut too much further. And that also, of course, that inflation in Australia remains sort of fairly sticky. So we're seeing the Aussie dollar do relatively well. We have a little position on Aussie long versus the Swiss franc, which is going up. So again, we're seeing that some of these risk currencies are outperforming the risk off currencies, with the exception of the yen. The yen is a bit of an outlier, so it's like the Swiss franc is taking a lot of that. We also see here that New Zealand, the Reserve Bank of New Zealand, they have their meeting on the 19th, so that's going to be Tuesday night. And again, they're priced in by the market for two cuts. So we see here 47.6 basis points. So let's call it 1.9 cut. Let's call it two cuts. We also saw over the weekend their so-called shadow board released their recommendation to cut twice. And the shadow board is this independent kind of group of sort of thought leaders, economists, business people who give recommendations to the board of the Reserve Bank of New Zealand. So we're expecting there two cuts, nothing that would be completely priced in. New Zealand economy, a lot of people are leaving. There's been a bit of emigration, difficult economic times, underperforming Australia and underperforming even places like China. So the New Zealand dollar is definitely on the back foot. Let's look at a couple of other markets here. Yeah, so something I did want to look at as well is just the general commodities market. So let's look at something like GSG, guys. GSG, which is, it's a general commodity market, ETF, but it has quite a lot of energy in it. And what you can see here is that it's not really sort of exploding to the upside or to the downside. And we see that this price here is sort of, $23-ish, just over 20, around about $23 is quite a barrier here. And again, until and unless that goes a lot higher, we have to say that, inflation may remain sticky in the US, but it's not going to be pushed by commodities to have a really powerful inflation. So it's going to be quite interesting just to keep an eye on something like GSG here, because we know that Scott Bessent at the Treasury and Trump, we know that they want low energy prices and commodity prices in general. So I think it's going to be difficult for GSG to really break high. And if that's the case, that should be supportive for long bonds and ultimately for a sort of a benign inflationary kind of situation. Talking about energy, some pretty interesting stuff going on. We see here, this is the front oil contract CL1. The March contract is actually expiring at the end of this week. Let's first of all just look at some of the time spreads, because it's the price action has been very weak here. So what I want to do is just to quickly look at some time spreads here. Just give me a second, guys. I'll bring it up. So go into energy and we'll look at the curve. Okay, so what we can see here, and I just want to put that compared to, let's say, a day ago, and let's say a week ago, and let's say a month ago. Right, so that gives us a pretty good sense of what's going on here. So you can see here a month ago, Each dot represents one forward month. So you can see here, obviously, the outright price, was at about $78, now trading around about, a lot lower than that, around about $70 or so. So what we can see here is basically that not only has the outright price gone, but we're looking at the live price, which is the white one here. You can see that the curve is flattening. So that is not a good sign. That's a sign of a market which is had been, for a long time in backwardation, a pretty strong backwardation, but is now flipping flat and maybe even going into contango. You see a lot of the losses here really concentrated at the front end. So this is pretty bearish. And if we actually look just at a couple of factors for that, and just keep a look at the price action here. So we see the price action here. It's been rejected. Every sort of bounce has been rejected. Fib levels haven't held. The only thing which has been holding, you see this big downtrend here. It kind of bounced at that. I was looking at this last night. It bounced up over that. But to be honest, I mean, it might stabilize down here, but the chances of this pushing up another $2 or $3 are very limited unless we get, again, another kind of exogenous link. And part of the problems there, we got some news, a little bit of news, is that the sort of semi-autonomous region of Kurdistan in Iraq, they haven't been exporting oil for a long time, but they announced over the weekend that they are now ready to start exporting oil. So that's going to add another, I think, a couple of 100,000 barrels onto the market. So Kurdistan is going to start exporting. Secondly, there seems to be some deal going on behind the scenes. So talking about geopolitics, the Trump administration, some senior officials are meeting with senior officials of the Russian administration in Saudi Arabia, I believe on Tuesday. So in a couple of days, tomorrow. Ostensibly to begin, setting the framework for a deal in Ukraine. But you have to believe that the question of energy is very much on the agenda, and we know that Trump and Bessent, as I just mentioned, they definitely want a lower oil price. We know that Trump in 2020 put a lot of pressure on OPEC Plus to cut oil prices, and they actually did. Well, not cut oil prices, but they certainly you know altered their production to reduce the cost of oil. So the thing is that we know now that Trump is prepared to do a deal. So the question really is, what is potentially going to happen here? Is this going to be some kind of grand alliance that somehow Trump and the Russians and the Saudis say, hey, this is how we want this post-Ukraine war to look like. This is going to be the energy. Could it be that, for example, the US says, hey, we want to be sending a lot of our LNG to make money, to change the deficits, and to get, make a profit from that. We want to be selling that into Western Europe. And in exchange, they're saying, hey, Russia, you traditionally have supplied Europe a lot of LNG. Maybe you can find other markets, but we will, on the other hand, support your land claims in Ukraine. And in somehow Saudi Arabia involved in that Saudi Arabia gets carte blanche, and there's something going on. And again, I don't claim to know what's going to go on in that meeting, but it feels to me as though something is cooking. And we know that both Russia and the Saudis want relatively high prices, probably more like it was in the 70s and early 80s. We know that Trump can put pressure on because of Ukraine and land. So there's a lot of stuff going on. All I would say is that at this point, I'm looking at the price action, and the price action in crude oil is very, very weak. As I said, cannot sustain any bounces. It's being rejected at all fib levels. It's coming back through fib levels. We'll see what happens today. So I think oil definitely be keeping an eye on any sort of sense of what the grand alliance is, because there definitely seems to me to be some kind of grand plan happening. So that's that. The other thing, finally, guys, just want to talk about, just have a quick look at equities. And again, talking about Europe, kind of interesting. Actually, we'll look at gold as well. So gold, let's have a look at gold. Had a bit of a sell-off day on Friday, but you've got to look at, let's say, something like the weeklies. And you see it's very, very overbought. Or, and if we look at, we'll start putting on, let's say I'll put on some indicators here. And this is on the weeklies. You can see something like gold here. You can see that, potentially it could go higher. There is a sort of a channel on the top around about $3,000. But if you look in the Bollinger Bands here, the top one, it's completely oversold. sorry, overbought. You see on all the momentum indicators and everything, very much due for a pullback. So this doesn't mean that somehow gold is, sort of not going to go up or anything. But if we do get, sort of some kind of settlement in the Ukraine, you've got to think that gold, was a little bit overbought and maybe can come back. Now, what would be a good price for gold? I think gold, definitely, let's say, like looking on spot, something like 28.37 I've got, something around about here-ish, just in the middle of the Bollinger Bands, which is, a bit of a level. I think that could be interesting. And then maybe even down to 27.96, you've got sort of this level down here. So I think anything down around about here, as I say, around about, you know, 28.30, 28.35, and even down in this little box here, which is about, 27.90. That would be an interesting entry point. You can't buy it up here, but if it comes back down here, that could be pretty interesting. And again, we know that the Chinese central bank is buying, but you really want to be buying maybe at the central sort of moving average here, or even the bottom of the Bollinger Bands on the dailies, or even maybe on the weeklies. Could be an interesting one because we know a lot of these technical buys are doing that. So you see something like here on the lower Bollinger Band on the weekly is about 27.13. But keep in mind, we do have this uptrend channel. So, the upper, target is still, potentially 3,000. Now, talking about things which have been going parabolic a little bit, we have the Euro stock. So we'll just go on, let's say the FEXX, which is where's that? There we go. Which, as you see, has been going very, very strongly here. But again, if we look here, we've got on the weekly, we can see that it's well above sort of the Bollinger Bands. And this level on the top here, which is 5,531, you see this horizontal, this goes back until about the year 2000. This is literally the highest it's been for 25 years. So yeah, is this a sort of a bull market? Yes, but it's extremely sort of overbought, and it's also got some overhead resistance here. And again, do I see a scenario where there's some sort of negotiated settlement in Ukraine? Yes. Is there going to be a lot of reconstruction in Ukraine? Yes. Is there potentially, maybe, for a common Eurobond to be issued to help with reconstruction in Ukraine and also to pay for defense? Yes, that's possible. So it is possible. But on the other hand, you also have, potential for a sticky negotiation. We also have the possibility that tariffs will be imposed by Trump. And you also have this issue that if Trump is less interested in supporting Europe militarily and might even, I don't know, withdraw from NATO, there's been a lot of talk in the last few days that Europeans will have to spend a lot more on defense themselves, maybe currently about 1 to 2% of GDP, up to 3, 4, 5% of GDP. That is going to cost money. That will require a lot of debt issuance, bond issuance. That could put the yields up. Borrowing costs could go up over the medium term. So the point is that Europe is still facing, a sluggish growth, unemployment. It's structurally, the productivity is horrible. I was reading today, like taxation, the percent of tax in countries like France and Italy is 50% of GDP. This is not a very efficient economy. But the point is, just from a market point of view, so Euro stocks, looking strong, trading strong, but the indicators here at this very strong overhead resistance, it's closing outside above the daily and weekly Bollinger Bands, which, as you can see, is a very rare occurrence. So this red one's the top Bollinger Band. You see it's pretty rare to close, and we've got 2 or 3 closes outside that. On this particular set of sort of indicators which I use, this is signaling a potential reversal with these yellow ones here. So it could spike up a little bit, but I think as we get into the nitty-gritty of trying to negotiate between Ukraine, Russia, the US, and Europe, there is a chance just for a little bit of a pullback. I'm not saying a collapse, because there is definitely reasons to be long Euro stocks. They're very undervalued from a PE, forward price to earnings kind of ratio. They're about 14. They're essentially valued at emerging market stocks compared to, let's say, the US, which is in the mid-20s. So definitely they represent good value. But, there are potential headwinds. And personally, I think there's opportunity in the next 2 or 3 weeks for a little bit of a pullback here. Just finally, guys, just looking at the US equities. Again, as I talked about at the beginning of this sort of overview, there's nothing particularly to say that the US equity should, stop going up, really. Or let's put it this way, they should go down. I mean, they're sort of trading in a range, almost at new highs. If you look at the cash SPX here at the top of the Bollinger Bands, and you've got to say that, if let's say we look at the weeklies, They're still got a little bit on the top of the Bollinger Bands, maybe 6150-ish, something like that. So there could still be a little bit more upside. They're not, outrageously overbought or anything like that. Could be a little bit more to the upside. And if we look at, let's say, the moving averages here, I just want to put on, let's say, the moving averages, or put on the exponential moving averages. You can see that at the end of the day, this is like the weeklies here, or even on the dailies, you can see that these moving averages are all sort of still trending upwards. So from a momentum trend following point of view, there's nothing technically telling us here that we need to be sort of shorting equities. We need more information. We need technical information. We need definite information about tariffs. Again, the market's probably 20 or 30% worried, still nervous about tariffs and whatnot, so it's not exploding to the upside. But there's no reason at this point to be putting on sort of serious shorts. Okay, guys, I think I've spoken long enough. I'll leave it there. Have a great sort of semi-market holiday today. Good day to do some reading and some research. And I'll be back again tomorrow. Hope that was useful. Thank you.